Good morning, traders. My name is Bennett Tyndall with TradingAnalysis.com, and this is our Elliottwave Wednesday live stream. Good morning once again, traders. Again, my name is Bennett with TradingAnalysis.com. Thank you all so much for tuning in this morning. Happy Wednesday, September 9th to you all. So guys, last week we were looking at overhead resistance in the NASDAQ in the form of the Wave 3 top near 12,000, near 12.5 actually here for the NASDAQ 100. And following the selling pressure that we saw on Thursday and into Friday, we're now tracking two wave counts. One wave count which would in fact suggest that was the Wave 3 top, and we're now consolidating in a Wave 4 position. Alternatively, we could assign the Wave 5 completion, but I just don't think the markets are quite there yet. So before we get to the charts, let's bring in the trading analysis team. And of course, we also have Todd Gordon of Ascent Wealth Partners with us. Good morning, gentlemen. How are you guys doing?
Very good. How you guys doing?
Morning, everybody.
Good morning, Terry, Todd, Alex.
Welcome back, Todd.
Thanks. Missed you guys. How y'all doing?
We're doing well. How are things in your neck of the woods?
Everything's good. Everything's good. It was getting boring watching the market go up every day. No, just kidding.
It can't go in a straight line forever, you know?
No way. No, everything's good. Everything's good. Life's good on the wealth management side. Miss you guys. Keeping up with the fine work that you're doing day to day in the member site and on the Wednesday show. And I just thought I'd drop back in and just say hi and just say you guys are doing a great job and hope all's well. So I'll contribute where I can here.
Awesome, appreciate it. Thank you so much for joining us this morning. And guys, let's jump into it. We got started a little bit late here. We do apologize, but we're going to go ahead and bring over the Motive Wave window, our preferred charting platform for not only Elliott Wave and Fibonacci, but all forms technical analysis. So this is the wave count that we had in front of you last week, and what we were viewing there in the September 1st high, we were looking at that as a Wave 3 position of the minor degree, which was part of the overall fifth wave of the intermediate degree. And we initially had a bit of a pullback into what would have been fourth wave support. We've obviously broken through that. So where does that leave us in terms of the Elliott wave count? Well, certainly we could in fact entertain the idea that this was the completion of the overall 5-wave motive impulsive sequence off of the March 2020 lows. But even if this is the case, this just puts us in a Wave 2 correction and still continuing the higher degree uptrend. Alternatively, this is simply a Wave 4 pullback. In fact, within this particular interpretation, within this blue Wave 3, we've got some really solid fib work going on. There's no question that the subdivision of this structure has been a little bit challenging and that it can be extremely fractal and finding a nice clear 5-wave subdivision in a third wave position is a little bit difficult. But I want you guys to take a look at this, and off of the March lows, this would be your initial 1-2. We then have essentially a progression of 1-2s with progressively smaller net percent retracement, so that's very appropriate. We've got squaring of our Wave 4s, so this Wave 4 squares up to this Wave 2 here, orange Wave 4 squares up to orange Wave 2, green 4 squares up to green 2, green 5 was equal to green 1, which is very common when you have that extended third. And take a look at this third wave, right into a 1.618 extension or multiple of Wave 1. So this puts us in a Wave 4 with support down towards 10,000. Do we think this is the end of the higher degree uptrend? Absolutely not. So we're going to continue to track both of these interpretations. You have a pretty good clustering of fib support that's offered down here between 10,213 and call it 10.5 for the overall NASDAQ. Taking a look at the S&P, and the subdivision of the structure off of the March lows becomes even more challenging, and that's absolutely fine. If you consider the psychology of the market going into that March low and the move that we saw out of it, I wouldn't expect to see perfect, clear, textbook 5-wave subdivisions with such indecisiveness as we were coming out of that kind of extreme in the March low there. So This is a similar wave count, which puts us in an overall fourth wave correction with still overall upside left to go. Alternatively, you could in fact get a 5-wave completion there, putting us in that wave 2 correction to the downside. Now, before we carry on, I wanted to bring over the put-call ratio, or in this case, the call-put ratio, as we are inverting it. And you know what we're looking at here, if in fact we are in a fourth wave correction, is the possibility that as the markets consolidate in wave 4, we'll see call buying consolidate, the markets will advance to a new high, call buying will set a lower high, the markets will then have the wave 2 correction as we see the divergence on this particular market internal. So that would kind of support the idea that we've got a wave 4 down, wave 5 up to go, we get the divergence in the internals, and then we perhaps have some additional selling pressure and volatility heading into election season, not really out of the ordinary. So not too overly concerned on the pullback there. Team, what are you guys thinking? What are you seeing? Any input on the index charts before we carry on? And I've got a couple other charts I do want to take a look at. Nobody?
No.
Anybody?
No,
You guys like it?
I'm with you. I'm with you. It's a hard. It was an unrelenting, non-correcting rally. I think in the Nasdaq and the XLK, I don't think there was anything less than a 7% drop. I think what are we right now? Are we at 8 or 9%, or did we hit 10? I don't know where we are on the Nasdaq right now, but it's
about
it's
8%.
hard. About 8% right now.
Mm-hmm.
Yeah, I think 7 and
Peak to trough, it was 11.
oh, it was 11. Okay, so we're about 8 or 9 off the bounce or whatever.
Mm-hmm.
When we open. Yeah, it's just this is the one, and I've always said this to you guys. This is the one kind of shortcoming of Elliott, or this is the one really challenging areas. I mean, I think the team would agree that corrections. I think trading analysis has a really good handle. The team has a really good handle on calling the corrections. But when there's limited subdivisions of a one-way freight train of a move, that's where Elliott really, I think we would have a hard time with it. Would you guys agree with that statement?
Yeah, certainly. Yeah. The subdivisions have been very challenging in this move. Certainly.
For sure.
Zoom in a little bit closer in time, Bennett. Down maybe the 195. But so the thing that's catching me here is the verticality of this move and the similarity of the verticality we had back in late February. But also, when we'll take a look that we're actually close to the 50-day moving average on both of these indexes right now, which I think is usually recognized as at least a short-term support level here. So I think this is a decision time here too. A lot of traders, Todd, catch me if I'm wrong here, but a lot of traders will use a 50-day moving average to add to positions. They use other indicators to take their profits, but certainly if we've got a correction going, you get down, and if you still got a strong market look ahead, the 50-day is a good place to get back in sometimes on some of your stocks. So interesting to see how the market reacts, whether we breach through this 50-day moving average and continue to march to the 200 or not. So what are your thoughts there?
No, I totally agree with that, and 50 day is certainly key. And the other thing I would keep in mind is, and I'm not trying to downplay the severity of this move. It was really fast on the upside. It's been really fast on the downside, but you got to keep in mind what time of year it is. It's summer. We just got through Labor Day weekend. There's a lot of, it's still a thinner market. I don't buy into the old adage of junior traders. Maybe I don't think the junior traders are allowed to push any size around, but I just generally think people are underperforming. People are riding the existing positions they have, institutions, and then you get this whole fleet of Robin Hood, David Portnoy led, smaller traders in, and it can create some whippy price action. But the point is, Labor Day on professional trading desks is still considered summer trading, which is generally thinner. So you got to kind of take that with a grain of salt in terms of the severity of the move. Don't read too much into it. We have a Fed that is just came out, and it's not getting enough airplay right now. It's unbelievable. The Fed just pretty much moved away from their 2% inflation. If they could ever get 2% sustained inflation, they're going to tolerate it. They just basically said they're not going to do what they did over the last twice or three times over the last 8 years, which is start to talk up interest rates and say we're going to get tight. Now they're just saying basically we're not going to do it. We're going to let this thing go. And the Fed has unbelievable amounts of liquidity in the market. I think there's a little bit of position squaring ahead of the election. I mean, the election's there's less than 2 months away, which is unbelievable. For me, I've got my personal accounts, and the way I'm handling my clients is, we've been buying on the way up. None of the clients that I run, that I manage, are fully invested, and we're using it. We'll use opportunities like this to add to positions that we want. So this was a tough market. I was talking to the team behind the scenes and trying to encourage them, say, listen, it's kind of hard, but you kind of have to buy breakouts for little moves. You guys caught a couple nice trades in there. But this was going to come, and you had to be prepared for this. But, Bennett, when I don't want to talk too much, I do have 2 charts I want to show you, just bigger.
Yeah, of course.
NASDAQ's Ben, but you tell me when you want to come in.
If you're ready to run through those charts and you want to do that now, we'll make you presenter and we'll get you.
You're the boss. You tell me it's just bigger picture NASDAQ stuff. You tell me where it fits in.
Coming at you right now.
Okay.
The screen is yours.
Okay. So just getting some kind of bigger picture context on the NASDAQ, and I've shared this with members, just where we are from an Elliott point of view. The NASDAQ 100, keep in mind, guys, that's different than the NASDAQ composite. But the NASDAQ 100, which is the NASDAQ that has futures contracts, when they used to trade a lot on the floor in the CME, it was based on the NASDAQ 100, which is the largest 100, basically 100 tech stocks in the land. So this is the one you want to look at. It was formed in 1985, and if you do some Wikipedia research on it, it's a little ambiguous as to what exact price it started trading. It came out at 125, and then a couple months later it was up to 800. They reset it back down to 175 or something. And it matters where this NASDAQ started trading. But I have this set at 125 in terms of when the NASDAQ started trading. So you have a big move up, and then here's the tech collapse, okay, down to wave 2.
That's the first bubble. That was the dot-com boom and bust.
Yeah, that was the dot-com boom and bust, exactly. So from there, we went up in 1, down in 2. Here's the credit crisis in wave 2, and I'm squaring it up to Bennett, Terry, and Alex's count. I believe, and make sure I'm correct with this, Bennett, off on your screen, but are we counting this from December 2008 as a large ongoing wave 5 or fifth wave 5 move of a higher degree third?
No, your count there is accurate. That's the one we're tracking.
Okay.
Yeah.
Okay. So the point I wanted to make here is, even if you take those away, if you use the 125 starting price in the NASDAQ, we at 7,300 in the NDX are only at a 0.618 relationship on a percent scale, log scale move, right? On a log scale. So this rally's only gone 0.618 of the prior first wave. Right. Typically, it go to 100%, which I don't even want to tell you, but you can see the number in front of you. This is it's a conversation that we often have, which is you got to have context of the size of the chart you're looking at. I mean, this could be, this could take another 10, 15, 20 years to get up to this point.
Yeah.
But just keep in mind that, this looks to be a very incomplete wave 3. Within this wave 3, I see one sizable correction, which was the credit crisis low. And then, forgive me, I'm doing this on the Mac. I'm not great with hotkeys on the Mac. And I don't know if you can hear the baby crying in the background. But we're at
you're good.
Okay. So we're at a 200% projection of green 1 and green 2. We could have stopped there. That's certainly been an amazing move, but it doesn't look like it wants to. So even going even further down, wave 3 would put you at 15,003 in the NDX, and then going down to even one lower level, which again I don't know how to do this. There we go. No, baby. I'm going to get cut off in a second. She's going to burst them out. I decided to work home today. So there's still room to go up to 503 to 15.3, and then I believe what Bennett just gave you guys is from the March low. He's looking at wave 1, 2, and then that would fit into high degree orange 5. Are we squaring up? Are we on the same page?
Yeah, it looks like you're working a slightly different higher degree count, but the implications of the move off the credit crisis lows in that wave 5 are absolutely the same. So yeah, I like that a lot.
Gotcha. Okay.
One thing I'd like to hope that the guideline of alternation comes into play on your cycle degree.
I know.
So that you got a directional wave 2, and let's hope that we get a sideways 4. I don't want to see a directional wave 4.
Terry, again, context is everything from an investment point of view and longer term portfolio management. Yeah. I hope you're right, but from a trading point of view, for trading analysis business, those short-term guys actually enjoy that more. But you're right. So and then the other thing is I've showed this before. I talked about this. I've been doing CNBC almost every day. They've been working me hard. I've got the studio set up in our Saratoga Wealth Management office, and I've been doing a lot of CNBC. And this is another one that I brought up before, which is Elliott aside, just looking at ranges and volatility.
Yep.
I really like this chart from the oh, sorry, I got to get all these notifications off. Looks like I'm speaking at the NASDAQ in October 19th. You guys now know that. So the other thing is, if you look at the APTR, so this is average true range, guys, but they normalize it based on percent. All right. I really like this indicator to get an idea of high to low percent change. Basically, it's showing range expansion. The more range there is, the more excitement, the more emotion, the more investor psychology is really driving things, fundamentals aside. So right now, over the last 21 months, we're doing 9.5% high to low in the NDX. It's come off the lows. And the presentations I've given in the last 10 years or so, I was making the point that if you switch this over to the Dow, these ranges that we saw in 2015 into 2017 were the lowest in over 100 years, because the Dow has been trading since the late 1800s. So we're coming off historically, like century-long low volatility. So we're just starting to come up off the lows, which is completely normal. I had this little debate with Guy Adami on Fast Money on this, and I'm saying it's just mean reversion on volatility from historically oversold, and that's all it is. The other point that I'll make is, if you think this is anything like the tech bubble, which from a fundamental valuation point of view, it's not. These companies have significantly more cash in the balance sheet. If you look at the volatility that was experienced in the late 90s tech bubble, it got up to, look over to the right, 14.5% before the NASDAQ topped out. And that's when vol really exploded as the market sold off. But the point is, vol was expanding up to 14.5%. We're only at 9.5%. So, we still have considerably more to go. We're not even at ranges seen from this move up here. I mean, this was obviously a range expansion in a bear market. So I want to look at range expansion in a bull market. So from an investor sentiment point of view, we're nowhere near what we saw in the tech bubble for multiple reasons. And then the last thing I'll say, I had this debate on Apple. Some would say, I did cite $115 support. It's just simple parallel channel support on a log scale on Apple. I got in a debate with somebody about valuations, and something that's interesting with Apple, which is obviously such an important tech stock. Right now, I think Apple's trading about 27 times forward earnings, next year's forward earnings, which a lot would say that's very expensive. Something interesting, and I think, Terry, you might appreciate this, is Apple, before their first iPhone launch, was trading about 12 to 14 times earnings. And before the major rally that we just had, it was like 17 or 18 times. But right in 2007, when they were just about to release their first iPhone, they got up to 30 times earnings, but they grew revenue like 50% for the next 5 years. The reason I say that is, are we on this next cycle with Apple and the new 5G phone, studying really what 5G means? And we have some 5G names that we've been watching. It's amazing what the implications for 5G are, and for driverless cars and artificial intelligence, connected cities, connected houses. So I'm just saying, are we seeing 2007 again in Apple? And I'm not trying to come out here and be perma bull. The guys are doing amazing work in the short term and the medium term, showing the ends of waves. But I think it's important to keep in mind, what the market's been doing. Not only the NASDAQ, but you look at the Dow. It's just this market has been going up for 100. I mean, this is the correction that you're talking about right here in the history of the Dow. That's all it is. So I just, from an investment point of view, I'm doing very little in my portfolio. Yeah, I just had a 6-figure swing in my portfolio. It's fine. I'm good with it. I've done some option hedging. I've put some hedges on, but I'm not doing much. I'm watching what the guys are saying on the trading analysis side, and I'm not overly concerned. I think there's a lot of tailwinds behind this market, and as we get into the back half of the year, I think I think things stabilize. So I'll just leave it there.
Very good, much appreciated, Todd. No, that's right in line kind of with the discussion that we were having this morning. So glad to have you on. Yeah, a friend of mine had messaged me yesterday, and he's like, "Man, look at Tesla down 20-some% in one session," and I'm like, put it into context as to where Tesla's come from. Like, what's a 20% haircut? It's just, come on.
Nothing. Yeah. So okay. So on that point, like, they're doing 30% a month right now. In the last 21 months, they're doing 30% range a month. I mean, that's unbelievable.
That is.
On the week, they're doing 17% a week. And I mean, again, you just look at that chart. I mean, that's the pullback that everyone's getting. So, I mean, the stock was at $42 post pre-split, and now we're at $330. So, yeah, it's and Tesla's and here's I don't want to take this the discussion.
No, you're good.
Here,
Glad.
But I thought the Nikola investment in the GM investment in Nikola was interesting. Do you guys know? There's a lot to be said, I think, for the EV market, for first to market. The infrastructure they've built out for charging is going to be really hard to replicate. And I don't know this. I tried to do some research. Terry, Alex, Bennett, if you guys know, or anybody on the YouTube stream knows, tell me about this. But as far as I'm concerned, there's not going to be a lot of infrastructure sharing for electric vehicles on the road. I think they have to build out their own components and infrastructure. Tesla's got a major heads up on that. And one of the biggest concerns with electric vehicles is range anxiety. People, if you're doing a 20, 30 mile commute, they're amazing. But to really buy it, embrace it, and do a 300 or 400 mile commute, and you don't know where your charging station is, that's going to be problematic. And I think people aren't really talking about that yet.
I was looking using Google Maps last week, actually, on this same subject. Trying. You can go in and type Google Maps and Tesla charging stations, and I think you can pop them up on the screen. But I was looking to see where they were in Texas. Obviously, I don't own a Tesla, but I was just curious to see where the population density of those things were. You're right. We're not going to get rid of motor fuel driven vehicles for quite a long time. The transition, the infrastructure is not there, like you said. And if you want to take a road trip and it's more than 300 miles that you want to travel in a single day, you're not going to do it on a car that's powered by electricity you got
to plan it out,
miles, right? Well, otherwise, or you're going to say, okay, well, we're going to sit there for the next 2 hours and charge the vehicle so we can go another 300 miles, which I guess that's adapting and changing your traveling habits. That's for sure. I want to bring one other point up that I thought was interesting. I was reading an article the other day about the return of outdoor drive-in movie theaters, car hop locations, and the fact that people are returning, even people in the urban areas that typically relied on public transportation are now buying their own vehicles so they can be more independent. That's kind of an interesting thing, that we may return to a higher automotive demand post COVID than we had before. So so watch out there for gasoline demand in the future. Is what I'm most interested in.
Yeah, no, I got you. And I'm just responding to TS right there. Sorry to go off. He goes, that's one of the most wickedly bullish Elliottwave counts one could possibly envision. My knowledge base suggests one should more or less line up the S&P 500 long-term count with NASDAQ. No, we
just
can
type Tesla charging stations in there, and I think you'll get some of them to pop up on your Google Maps there.
Oh, I did before, but let me just address this. I mean, look, TS, at the end of the day, and we talked about this. The Elliottwave is it's just studying it's studying human progress. Okay, it's Elliottwave is studying the scorecard of human progress, which is basically a measure of our productivity, our mass productivity, our societal progress, how we're getting along. The better we're doing as a society, the higher our progress, productive capacity, our output, the higher our stock prices. So Elliottwave is just measuring human progress. For me, I think it's irresponsible, and I think it's probably ill-advised to not be bullish on our productive capacity as humans. I think generally we're doing better. I think we're improving as a civilization. I think we're learning hopefully how to get along better than we have in the past, and not making catastrophic mistakes. So yeah, I'm not making a statement on whether we have climate change, if it's going to be a serious short-term problem, but I think it's irresponsible to not have a wildly bullish count on our productive capacity. I think in the near term, and again, context of time frames is everything, because a 20% drop, if you're over invested or over leveraged and you're not ready for it, it's really going to hurt. But I think on the longer term, for most of our investment time frames, I think it's something that you really, really need to think about.
Well, it's healthy. It's healthy. Like we said, the market can't go in a straight line all the time. It needs to have these healthy corrections. I'm all in favor of the healthy corrections, and this is what I was saying last week, is what I expected was a bit of a healthy correction to be coming up shortly, and lo and behold, it did happen. But I'm not like you. I'm more long-term bullish. I'm not expecting the end of the world crash right around the corner here. So great.
Yeah, you can't look at every 5-wave move on a weekly chart and say, oh, we're going to retrace 50-60% of this.
Right.
It just doesn't happen.
This is going to be, and again, this is, I've shown Bennett and Terry and Alex, I've shown the guys this, but I mean, what happens if, there's nothing academically wrong with this count? What happens if that was wave 2? Since 2018, that was wave 2, and this was a completed 5-wave move. Very well could be, right? Have you guys, in your work, found any way that we could rule that out?
No, it's valid. It's valid.
I mean, it's unbelievable, but I mean, that's, that's actually an expanded flat correction, wave 2, larger correction, both price and time, than anything we've seen.
Do this. Move orange one swing to the left and make that back into the flat. So it's identical, a larger degree correction similar to that.
Yeah, and you're satisfying the guideline of alternation. I mean, that's a very odd, rare running correction, which foretells a really strong wave 3, and then we get also a really strong wave 5, and that's just a simple zigzag. I mean, larger correction, price and time, then. So, all right, you're right, yes, the true strength of Elliott ways to show the possibilities and take the bias out. Yeah, that's exactly it. It's just, It takes EQ to be an investor, which is emotional intelligence, to be smart enough to know you can't foretell the future. You just have to be confident enough to smart enough to know you can't foretell the future. You just have to be content stepping into the unknown, taking the most probabilistic way, and trusting that, you know, our information is imperfect, and it can't be perfect. It can't be. So it's more about EQ than IQ. So, guys, I've taken up way too much of your time, but I just wanted to drop in and say what's up. You guys are doing a great job, and I'm gonna step back and listen.
No, absolutely, man. I appreciate it. Good. It was a good discussion we had there this morning. All right, Terry, you want to bring us up to speed, cover what is happening in sector rotation, and then we'll get into our macro overview as we approach the open here. All right, the screen is yours.
We'll be brief today. I'm just going to cover a couple of things. This is last week's sector performance here, what I've got. I just want you guys to note, this is the energy sector was down a little bit, about 4.5%, and tech down 4% last week. We had a short trading week this week, with Monday being a holiday. So we got one down bar. So look over here. This says a week, but this is actually just yesterday's trading. So yesterday's trading, technology was down a 4.5%. So this was all of last week. This is yesterday, and I mean, it's just kind of amazing that you're getting almost the same push in a single day that we saw in the entirety of last week. I will admit, though, the first half of last week was in an uptrend here. Get this out of the way, and then we saw the correction roll over. And the thing I noted earlier was for the S&P, we're approaching this 50-day moving average, and here on the Nasdaq, we've touched that. Real quick on growth versus value. Where are we in the growth versus value? We are seeing growth losing some momentum and a little bit of relative strength here, but all we're really seeing in value is we're just seeing a momentum push. And I think a lot of the stocks that I'm looking at in the non-tech and non-communication sectors are moving up are mostly a momentum related push. And I think you can see that here in our weekly rotation. Here's technology, here's communication, and you can see them coming down in terms of momentum and a little bit of slight relative strength giveaway here over the last 4 weeks in technology. Not really giving away any relative strength in communications, and we are benchmarked here to the S&P. But what you're seeing here is a lot of these underperforming sectors, from materials all the way down to the energy. You're seeing a lot of vertical upthrust movement. So that means they're gaining momentum and a little bit of gaining relative strength at the same time there. So I'm not abandoning ship on the technology being remaining in the lead. I think that's where we go. We talked a little bit last week about in the tech sector, and this is my top 20 stocks in the tech sector. We do have quite a bit of collection of stocks that are down here in this lagging quadrant. A couple like Cisco and Intel continuing to push further, weakening, maybe Oracle too. Most of the others are showing a little bit of momentum upthrust here. Our leaders, NVIDIA, is now starting to gain slowly a little bit of momentum and has stopped losing relative strength. So I think that's a very positive, although I'm seeing PayPal continue a bit of decline. And AMD. So AMD is I think is going to become our new leader soon. Its relative strength ratio is just about a point away from NVIDIA, crossing over. And this is your chart on AMD. And what I was pointing, I drew a little arrow here to kind of point at the sharpness of the move down, the dip down, the candle wick, and whatever. But AMD is still running way above even the 20-day moving average here. So AMD, being the leader it is not taking as big a hit as the rest of the market. And the semiconductors, a lot of the semiconductors, though, you can see collectively losing relative strength and momentum, pushing to the southwest. Not a good sign for these guys. But again, there's AMD and NVIDIA at the top of that list. let's look over here in discretionary. So in the discretionary, again, continuing to see some gains here in the travel and leisure segment here with Marriott and Hilton gaining some strength here. Amazon and eBay kind of running a parallel channel down here in the weakening quadrant.
That's really interesting. Don't you?
Yeah, go ahead.
Is it the first time? Is it the first time you've seen that the travel-related names starting to move into the lead towards the leading
I pointed this out a week or two ago that I was because you can see in the in the rotation here's where the turn happened, and that was 821 to 828. So the last week of August saw Marriott, Hilton, Royal Caribbean, several others, Norwegian Cruise Lines, I believe, a lot of them starting to hook and actually start to show some northeasterly headings here where they're gaining. And you can see the other thing, as I point out, is if you look at the velocity here, the velocity here back here on 828 was a 1.64. Now it's and then the next week it was 2.21 and then 2.47. So increasing velocity means acceleration. So we're seeing an acceleration of the move of these guys up and out of this improving quadrant. Could potentially push them over into the leading quadrant soon, unless we get a rapid reversal out of these discretionary stocks here. In the materials sector, really, there's really nothing shining in the materials sector other than gold, right? So it's the gold miners index. Just about everybody I've got in this list here is running with a relative strength ratio higher than the S&P, although there are several in the group that are actually positioning themselves to the left here. There is a collective little group here of Newmont Mining Gold, Franco-Nevada Gold, and Royal Gold, and what's this other? There's another one in here, Barrick Gold. They're actually seen losing relative strength ratio, and I don't know why that is. A lot of these stocks up here are gold plus silver, which have had a tremendous growth in strength, as Alex talks about the gold-silver ratio, outperforming silver, outperforming gold for a while. But excuse me. Now, many of these guys are remaining in our leads. In the communication sector, what I've been noticing here is a lot of these broadcast companies are actually starting to gain some push here. News Corp, Viacom, Discovery Channel, even though it's down here in the improving quadrant, Fox is in the lagging quadrant. They are all starting to see also this northeasterly heading and pushing themselves up.
What's Take What's Take Two Interactive doing? TTWO. How's that looking?
Yeah. So here's Take Two. That's it. If I mouse over it turns yellow. So there, it's this one right here. And we've seen Take Two actually move out of the leading quadrant down into the weakening, but that by itself doesn't mean get out of the stock.
Right.
Okay, that's not necessarily a negative signal. That's just a sign that there's a period of consolidation going on. I'm actually seeing Facebook move in the opposite direction here. If I pull up Take Two and pull your price chart, I made a lame attempt to stick some Elliott waves on here.
No, that's the wave 4 I'm actually looking at, and that wave 3 was a 1.618 multiple of your 1.
Yeah, there you go. So 1, 2, we're not invalid, no crossover there. I don't know about that wick and stuff. So, but yeah, I think Take Two. I think anytime I see a stock move down into the weakening quadrant, it has the potential to make a hook and rotate right back up. So we need to go dig into the Elliott wave and identify: are we at the end of a fifth wave and in a correction? Then I might expect this guy to push down into the lagging quadrant, or if we're in the a fourth wave, this is just a fourth wave consolidation. This will likely hook back up when we see a push into that higher fifth. Twitter's doing good. Twitter's actually if you were to look between Facebook and Twitter, I would say always pick Facebook, right? But Facebook's got a higher relative strength ratio. I like the chart pattern in Facebook a lot better than I like the chart pattern in Twitter. Twitter seems to kind of have lost its way. But I gotta say that in this most recent, this is weekly here. Let me get you down to the daily here. In the most weekly, it's been making a quite nice steady run up. Okay, is it time to buy the dip in Twitter? Possibly. We'll leave that for some additional analysis, but we're floating just below the 20-day moving average, above the 50. We'll see if we get a bounce and take off on another. The last thing I want to talk about is the industrials. So I've been telling you guys that certain segments of the industrial group have been pushing higher, and it's mostly found in the transports and some of these transport stocks, so these rail stocks and shipping companies. So I'm going to leave it there. So we got time for Alex.
Absolutely. I've been sitting here patiently waiting to hear from him, and we will get you up in just a second. What's happening, Alex? How are you doing, sir?
Well, Bennett, fine. Everything is good. So just watching the market as always. I think I'm gonna be, as they say, become solidified on my chair one day.
You got to get a standing desk then. You got to be able to switch it up.
First, I need a standing desk, and secondly, I need more vacation. So, okay. So,
all right. The screen is yours when you are ready.
Yeah, let's do the macro overview. Most of our wave counts from the last week was basically unfolding pretty nicely. Do you see my screen, Bennett?
Yep, yes. We've got you.
Okay, so this is the dollar index, and we are tracking a possible end of this very nice five-wave move to the downside. I will leave a small probability here that we might have another push to the downside. I don't think so, but possibility exists that this turns into some type of a flat correction, but I don't look much to the downside further. So I think we are in the last fifth wave sequence, either from here a little bit lower, or we already started. The sign of the further advance in dollar index on the upside will be if we cross 93.91 and develop more impulsive structure in this green wave 3, small pullback in a green wave 4, and the 5-wave move, I think, will mark the wave A of the first pullback in the dollar. And all of this agrees what we are talking also with the risk of move on stocks. And you can see on many currencies, especially on Japanese yen crosses, and also with the risk on currencies, the same thing. Everywhere we have a 5-wave move, and we are starting a big corrective pullback for the further advance. So I think looking into that, judging the currency markets, I think also the Bitcoin as well will start to align in the picture very well. So I think a 3-wave pullback in dollar, 3-wave pullback in stocks, in other currencies, and then we continue higher because the macro picture now aligns pretty perfectly for a possible bullish outcome somewhere from January, February next year. If we look also, we were kind of a looking move down in oil, and actually that has occurred in the last few days. This is an impulsive move on the upside with a nice finish in the ending diagonal. So I don't think this impulsive move to the downside yet has finished. I think it will actually complete its 5-wave move. We're going to do some type of a B-wave pullback, and then potentially all correction, or the first part of the something more complex might be finished in this area. And if you look copper as well, copper is also tracing out the ending diagonal after a huge move on the upside. Actually, I looked some of the data, and can you believe that Chinese are buying copper at the highest rate since 2002? Can you imagine that? So they're using advantage of the small and smaller prices, or the cheaper prices, and they're stocking their supplies. So they also have a view that the economy will will grow in 2021, and I think that the copper is already done its 5-wave move, a little bit more upside, and then I will look for a bigger correction. But from lows, a 5-wave move usually implies that we have another measured move, at least on the upside, after the corrective pullback. So the same picture everywhere. If you look all of the markets, everywhere you see a 5 waves up, and we are now due to a corrective pullback before we continue further on the upside. So the same picture on euro. The ECB is on Thursday, tomorrow, and we are going to see Christine Lagarde in the news. I think that the 5-way sequence mirroring dollar index potentially has already finished. I will allow a small flat, but less likely to. I think we're going to do on ECB a move lower in the wave A, pullback in the wave B, and the further continuation. Usual resting place is a 50% for euro. Many of these currencies has their own characteristics, and in 80% of the time their fib ratio works. For example, for pound, this is a 0.618 retracement, and for euro is usually 0.5 or 50% retracement in any of the pullbacks. So I think that the euro rally will continue on the upside after this pullback. So we are going to watch how this develops and continue to monitor our big wave count on the weekly and daily, which we have been looking from 2017, and it was quite unfolding quite nicely. I also want to show you something that I was kind of called about from many of the crypto community. We were talking last week about the possible move down in Ethereum, if you remember, so you can go and look our videos back, and some of the crypto pundits was telling me, no way, we're gonna go up, skyrocketing, and the other stuff. Eventually, what is happening on cryptos is exactly what we have did with our methodology. We had almost a very, very large pullback, which is already something about 36% down from our designated target. We were looking this on the higher time frame, and it was clear that we are still in a corrective channel, and I was expecting this pullback for a few weeks back, and it's happening now. Very clear pattern. We are looking for a 5-way move lower in A, up in B, down in C, and I mentioned several times the key to these crypto charts will be the move down. So I don't want to see from here a 5-way move development passing these support levels. If I see a 5-way move, I cannot stay bullish on Ethereum or less any other cryptos. So I think this move, which is unfolding now, will be crucial, and we need to pay attention to that. We already warned our members a long time ago on that one. So we are tracking this 5-way move in A, up in B, down in C to this support level, which we look to hold. Generally, we follow the sentiment. We are bullish, so we are looking for a bullish development there. And also, we were, if you can look here, it's my Twitter account, and sometimes I post some of the wave counts. We were looking for a pullback in Bitcoin very soon after this post triangle or a complex corrective pullback, and actually what happened is exactly that. We went lower from our designated target, a little bit more upside. We were wondering here, maybe we have a little bit more upside because this was relatively unclear. But now when we are unfolding in a 5-wave sequence here, this is definitely a first A wave possible, or a complex corrective pullback here on a Bitcoin. We expect a B wave, which we are going to try to exploit, move down in a C wave, and then we're going to look for a support around 8,000-9,000, even 7,000 on a Bitcoin. Overall wave count, it's still sideways. I mean, I cannot talk that enough to people. Everybody is still saying many stuff about cryptos, but guys, if you look the chart on daily level, we are sideways. We are not going anywhere for the last few years. We are just here using our skills and trying to pinpoint a possible, at least risky entry to explore the possibility we are going to continue higher. But this is not a sure thing. Okay, so we are still trading sideways. Nothing is still determined. And I think that we are going to look very carefully how this pullback will unfold, and we will look for a small confirmation to start to pursuing a bigger picture on the bullish Bitcoin wave count that we have. Also, this wave count agrees with overall macro picture with the lower dollar and the risk on in full mode after the elections. So I think that our probability wave count is pretty right, and the important moment will be actually here after this pullback is finished, as well as on Ethereum. So if you like to join us, please do.
Hey, Alex,
We do.
before you sign off, I'm sure you follow. I just want to insert this, and I love how you're usually on the other end of the collective crypto community, and some very famous market commentators are very bullish on Bitcoin, and I love how you're saying the time is not yet here. You often stand alone, and I can't tell you how many times that you've been ahead of the community. And there's a few names. One of them I remember saying on Twitter, he's irresponsibly long, and I kind of shook my head as a wow, just needs to follow Alex's work.
Yeah, but I mean, basically, all what we do is we rigorously, at least I rigorously follow what you have taught me, and with the practice of the Elliottwave methodology, I try to stick to it. I don't want to deviate and being influenced by other opinions or whatever. I have a trust in this methodology, doing it for 10, 11 years, and if I do it correctly, patiently, with the proper observation and practice, it basically never fails. So I was really called out on this Ethereum call pretty heavily, and why I thinking it's gonna retrace, but it was clear. I mean, for me, it was a really a breaking point. So that this will hold. We are still in a collective channel. We can count 5 waves up. We did some additional wave counts, but in general, if you look here, I have it before. The whole crypto community was pretty much bullish on it, and we posted this, I think, last week on Twitter, where the whole team was actually on, and it was here. So we were actually basically calling the reversal here in this area, and that actually what happened, thanks to the Elliottwave methodology, of course, not me. I was just interpreting relatively nice, so I must say. So I think that this move down, because the crypto community is pretty hyped on a further continuation, I would just say take it easy. We need to see what's going on here. So if this develops in a 5-wave move, I don't think that the crypto space will be attractive if we see that as it was before, because the 5-wave move here will actually tell us that potentially this was just a corrective channel. This was a wave A, this was a wave B, and you don't want to even see where the wave C is going. It's going far below 50. Okay, so I'm still on hold. Definitely, I want to put some longs here to test the waters, but I will just keep my steam on a very low level now as I saw this move down.
Very good, much appreciated, Alex. Yeah, that's a perfect example in that particular wave count there. When you've got 2 wave counts that are obviously supporting completely different movements, waiting for confirmation. So await price action, let the pattern develop, and then you can look to commit to a position. And Alex is always been on top of that. So excellent work, team. Much appreciated. Just watching the gap here in the markets. Anything else that you wanted to cover before we let you get out of here?
Yeah, I think there are some guys who want to see gold.
Yeah, if you could. Absolutely. The screen is yours whenever you're ready.
Let me just do gold for quickly. So gold is still in. We presented a possible triangle, and I think this is still pretty much valid on the gold wave count. Just
no, you were up.
Okay, I'm just looking for a gold chart. Okay, so here is a wave 1 and 2, and we are still looking this consolidation here, which basically goes nowhere. So we have a very defined zone here from the support at 1,863.36. And we are keep consolidating here, which might on the end turn to be a triangle with one more small push on the upside for this fifth wave. As long as we trade in this zone, I think we can keep this triangle alive. It can extend for some time, of course. You never know when triangles might finish. But I don't want to see this zone here invalidated. Okay, so this is a crucial zone to keeping the bullish wave count bullish this much, so I don't want to see any drop below these levels there, because we will have to redo the wave count. But in general, overall picture on gold for now stays relatively bullish for the further subdivisions in this 1, 2 potential wave 3, 4, and 5 for the bigger orange wave 3, then pullback in a wave 4 and a further continuation in a wave 5. And if we are following the 5-wave sequence, actually we will have still outperforming silver against the gold for some time, because the gold will finish very soon in 3-4-3-4, oscillating in this big corrective pullback, going up and down. And silver, we have a wave count which tells us that after a pullback it might finish on the very, very rapid rise after the pullback is completed. So so that's gold as I see it.
Let me ask you this: are you still counting the alternate, which suggests perhaps green wave 3 is anchored where orange 3 is, and we're actually in a minor degree fourth wave that would, if you zoom in a little bit, that would square up to that green box wave 2?
You mean if I put this green tree here and this? I mean, it can be, but this subdivision is not so clear inside. It might be. So I can do a leading diagonal here. I mean, people always object when you mess up with the wave counts, but you have to do. The point is that you have a trained eye, and that you know the patterns, how you can calibrate the wave count to respond to possible reality, to be as objective as you can. So we can do a wave 3 here, wave 4, and wave 5, but for now I don't have a need to do that. If I see this wave count corresponds to this reality, I can easily leave it for the green wave 4 and the blue wave 3 here. So I agree it can be done, but I would not like to change this wave count and adjust it yet. So I think this one is correlated to the current reality. Why? Because I'm very interesting if we continue lower, how the gold will correspond. Bitcoin is going down with the stock market, but the gold is holding. So I think that in possible corrective move down, it is perfectly well expected we have some sideways consolidation, one more move up, and then while the dollar starts pushing and starts to move a little bit higher, we see a bigger corrective pullback in gold. So gold is very mixed now. It has a many influences in it. It's not just the dollar story. It's not just the stock story. I think it's been mixed now more than ever. How the investors are seeing the potential reality of the world in the next year or two. So I think gold it's going to become more difficult and difficult to read, and that's why I think we are going to fall in this 3434 corrective pullback for the next year ahead.
Perfect, perfect, excellent answer. Well, thank you, trading analysis team. Thank you, Todd, for tuning in and joining us this morning. And if you guys enjoyed the content, please give it a thumbs up, subscribe, and turn on notifications if you want to stay up to date. You can check us out at tradinganalysis.com. And we've actually, we have an ongoing summer sale with a couple of products that are on sale through September 15th. So before you guys get out of there, we've got a little video that we're going to play here at the end to let you know about those courses if you're interested in learning Elliottwave and beginning your journey there. So team, be safe, stay healthy. Members, we'll be with you in about 10 minutes or so for our member webinar. Anything else you guys can think of that we forgot?
Just give us a thumbs up, guys. Appreciate it.
Thumbs up on YouTube, and Tesla's holding that 50 days you guys mentioned.
Here goes Tesla. Here goes Tesla. All right, guys. Hey, thank you all for tuning in, and we'll be back with you next week. Stay safe. Hey there, traders and investors. My name is Bennett Tyndall with TradingAnalysis.com. Hey, have you been considering learning Elliottwave, but you're not quite sure where to begin? Look, we get it. There are a ton of places that you can go online for finding educational material on learning Elliottwave. But we often find students are left not quite knowing where to begin, and more importantly, how some of the puzzle pieces actually fit together in the world of Elliottwave. So if that's you, look no further. Here at Trading Analysis, we put together 2 courses which are specifically designed to teach you Elliottwave from the ground up while shortening the learning curve along the way. And with our ongoing annual summer sale, which is currently in effect until September 15th, I can't think of a better time to dive in headfirst and begin your journey learning Elliott. So let's take a look at the offerings that we currently have up for sale. The first course that we have for sale is our Elliottwave Fast Track course. Now, I taught this, and it consists of 6 video lessons for over 5 hours of content. We start with an introduction to Elliottwave. We then move into what we consider to be the core patterns and key elements of Elliottwave. We discuss motive wave and corrective waves, along with the associated rules and guidelines. We then talk about the various tips and tricks that we use here on a daily basis at Trading Analysis. And then, of course, we get into some real-world application. This course regularly retails for $299. It's currently on sale for $199. Next up, we have our Elliottwave Mastery Course. And this is actually taught by our founder and CNBC contributor, Todd Gordon. And like our Fast Track course, it is also designed to teach you Elliottwave from the ground up. But unlike our Fast Track course, our Elliottwave Mastery Course takes it a step further, in that Todd takes the Elliottwave counts and he teaches you how to turn them into profitable trading opportunities. As you can see in these examples, he goes over the Elliottwave zigzag, the Elliottwave flat, along with the Elliottwave triangle, and he talks about entering trades based on those corrective patterns. In addition, he goes through various live option trading opportunities using the wave counts that he works together with you in the course. Now, perhaps you've already been using Elliottwave and maybe even following our work here at Trading Analysis, and you're ready to take your learning process to the next level. Well, in that case, this third offering might be right for you. And as you guys can see, it is a packaged bundle which includes not only our Elliottwave Fast Track and the Elliottwave Mastery Course, but it also includes 3 months worth of access to our Premier Trader subscription service. This has a retail value of $1,827. It's currently on sale through September 15th for $997. That's a savings of $830 to you. Now, our Premier Trader service includes option trade alerts, nightly strategy video updates, which is a fantastic avenue to continue your learning process in the world of Elliott, weekly sector rotation analysis, weekly member webinars, along with access to our mobile application. Here at Trading Analysis, we have an iOS and Android compatible mobile application, which we use to communicate our trade alerts to you. We have a members website, We have a members chart room. We have a trade desk. And of course, all of this is also communicated to you on the mobile application. In addition, as mentioned, we do have our nightly strategy video updates. These are Sunday night through Thursday night, with the exception of Wednesday, as Wednesday is our member webinar. And of course, the weekly member webinars, as you can see there on the right-hand side of your screen. Again, if you want to take advantage of these offers, you can go to our website, tradinganalysis.com/summer-sale to access all 3 of these current discounts. Now, I get it. Maybe you're not ready to dive in head first, but you are interested in Elliottwave, and you perhaps are interested in even seeing it in real time. In that case, I would encourage you to tune in to our Elliottwave Wednesday live stream show. We host this every Wednesday morning, unless otherwise noted, at 8:45 in the morning on Todd Gordon's YouTube channel. And in fact, we've had some fantastic guests, including John Najarian, Amelia Bordeaux, Julius DeKempner, and many, many more. So again, traders, if you want to take advantage of this, you can go to tradinganalysis.com/summer-sale to access all 3 of those current offerings. And again, thank you all for tuning into this video, and we'll see you guys on the next one. Take care.